Are you prepared for higher rates of inflation? That's what could be in store for us if the Federal Reserve does what some economists think they should: settle for higher rates of inflation rather than break the economy with interest rate increases. For the last decade, 2% has been the official inflation target of the Federal Reserve. However, getting prices back in line with that target could come at a terrible cost to the economy. Some economists say the risk is so high that the Fed should raise its target and tolerate higher inflation. So far, rate hikes have had no effect on stubbornly high inflation. The Core Consumer Price Index, CPI, accelerated 0.6% from August to September. On a year-over-year basis, core CPI was up 6.6% in September. That's the fastest 12-month increase in over 4 decades. Where does the Fed go from here? Accepting acutely higher inflation is not an option. But crushing the economy with even higher rates might prove even more devastating. One economist, who is the president of Queen's College, Cambridge, says inflation above target is the price the Fed and all of us could pay for how long it took the central banks to deal with soaring prices. What will force the Fed to change their target is the recognition that by being so late, they can't get back to that target. The chief economist at consulting firm RSM says getting the Fed's preferred inflation to 2% will cost 5.3 million jobs and an unemployment rate near 7%. He concludes the following about the Fed's inflation fight. We don't think 2% in the near term is a reality-based option. And economist Paul Romer, co-recipient of the 2018 Nobel Prize in Economics, says the Fed should adjust its inflation target higher. Earlier this year, Romer said we'd be much better off at a stable 3%, maybe a stable 4%. In June, Fed Chairman Jerome Powell responded to a question about whether the central bank would consider raising the target by saying flatly, "That's not something we would do." Really? Previously, Powell declared that Americans were in for some pain as the Fed ramped up its inflation fight. Some pain has translated into a loss of household wealth this year, estimated at up to $10 trillion. And headline CPI is still above 8%. Americans, and especially retirement savers, should be prepared for all manner of economic turmoil. This includes the possibility of a severe recession, as well as lasting higher inflation that steadily consumes the purchasing power of hard-earned savings.